We now take a quick tour through some of the R code provided in Module 5.1, Valuation Option Boundaries. Again, we'll just load the RPROJ file, which keeps a lot of the defaults and other things as before. We can, just depending on how I left it, you can have a variety of different things here. And so I can take out the trash, add several packages that will prove useful for this particular module. And I have several switches on whether I would like to include the lower bound time value for both calls and puts. And so these are just indicator functions basically in the different graphs that are produced. Do I want a fixed range or not? If I do want a fixed range, what are those ranges? And I set a whole bunch of defaults. The main goal here is so that I can compare empirical evidence based on different dates and different values and be able to do a reasonable comparison across a variety of different constraints. And so again, we're going to be calculating percentages based on the underlying instrument's value. If you'll notice, there's a lot of preset data files taken from the options market, and so I have a variety of different dates that were taken. The goal here is really just to understand the behavior of option prices and time value and put call parity and boundaries at different types of markets, high stressed markets, quote normal markets, and so on. And so the way this is going to work is there's a couple pieces of R code. One is the call lower bound, another one is the put lower bound, and then we also have put call parity. And so these particular functions will be called numerous times depending on the task at hand. And so initially, if I wanted to just look at some plots, I could load the particular file that provides some raw data, and that raw data is analyzed, producing the call lower bound. Again, this is strike price divided by the stock price, and so the lower the strike price for call options, the higher the intrinsic value. If you'll notice at this particular point in time, interest rates are above the dividend yield, therefore the lower bound is above the intrinsic value. These are American style options, and so you'll notice that this is asymptotically going to the highest lower bound or asymptotically going to zero. And so I can run this on several different dates, and you get different results depending on whether it's a high stressed point in time like December 15th, 2008 was a rather high stress time, and then going back to normal markets, it's lower. One of the interesting insights is that the highest lower bound switches depending on the interest rate and dividend yield, and the option prices asymptotically go to the highest lower bound. This is a clear indication that arbitrageurs are active in this particular market. And there are several other particular points in time that could be analyzed with calls. In the case of puts, we get the similar kind of result over these periods of time, and as was discussed in prior parts of this particular module. If we examine put call parity, we note that the results, the actual mid prices for the calls do lie within the expected range of put call parity. And so this is basically provides a variety of different outcomes depending on whether I'm focused on the call lower bound, the put lower bound, or put call parity. If we take a quick look at the different files, the call lower bound simply processes the data, reads the data in from the file. It focuses on call options or put options. In this particular case, it will be calls only, and the intrinsic value is simply the mid price minus the strike. The lower bound is the mid price minus the present value of dividends minus the strike, and then but it's the present value of the strike, and so this is the lower bound. Time value is simply the mid price minus intrinsic value, and then there's a variety of different plots produced. So the call lower bound and the put lower bound is very similar, just the focus is either on puts or on calls. And then finally there's put call parity, depending on how much dividends there are relative to interest rates. The conditions to calculate the lower bound and upper bounds of put call parity are fairly straightforward. And so I'd encourage you to spend a little bit of time with this code, explore these lower bounds, and begin increasing your familiarity with using R to do a variety of different analyses.